morning, ladies and gentlemen. I'm very happy to be here in Chisinau, and I thank the organizers, I thank the Bureau for inviting me here. If I use biblical language, paradise in the Bible is described as the land of milk and honey. I think Moldova is the land of wine and honey. So, very happy to be here. Why am I going to talk about Solvency II at this motor insurance conference? Well, ladies and gentlemen, motor insurance is very special. But it is not so special that it is not insurance. And that's why motor insurance eventually, we heard the panel talking about all the challenges that you face in introducing a liberalized market here. But in the end, motor insurance will also have to follow the basic rules of insurance. And I will go through these principles, trying to clarify what we here have in mind. This is the program. The clickers always are a challenge. Yes, it works. Okay, thank you very much. That's the agenda. Let's quickly go to my introductory comments. Yes, okay, there we are. Insurance, ladies and gentlemen, is about risk. We cannot live in today's world with all the risks, keeping those for ourselves. We all face a lot of risks, and we don't want to talk about it. This is one of the problems of insurance. Nobody, I'm sure, this morning got up out of bed and said, oh, I have to buy insurance. Somebody will have to come to you to sell it to you. Therefore, so important that the people who sell insurance are qualified people. Therefore, it's also important that people once in a while think about their risks. So insurance is about taking risks away from you and transferring those to a professional manager of risk, the insurer. But insurance is not only about risk, it is also about capital. This clicker doesn't seem to like me. Yes, there we are. If an insurer makes a promise, ladies and gentlemen, automatically it has to consider that the risk might materialize. So I need to have a liability on my balance sheet for the potential risk materializing. And these risks are usually referred to as expected risks. But over and above these technical provisions, which will be calculated by the actuaries, we also need to have a capital buffer. A buffer that will allow me as an insurer to pay when the day comes to pay. And that, ladies and gentlemen, is something that insurers sometimes forget. It is so nice to cash the premiums, but always keep in mind, you may have to pay. And that's why insurance is not only about risk, but also about capital. And insurance basically is about risk and capital. Insurers should therefore not engage in business for which they do not have the necessary amount of capital. And it is the definition of this capital amount which is referred to as solvency. How do we calculate this capital amount? And there are a number of ways to do so. And throughout the world, we have all agreed that the best way to do that is to have a risk-based solvency regime, risk-based capital regulation. Risk-based capital regulation, sometimes referred to risk-based capital or solvency regulation, but basically all countries in the world are moving towards that system. a system whereby insurers are required to link risk and capital. Now that is not so easy, and that's why I usually refer to this gentleman. That's not me, ladies and gentlemen. It's of course Einstein. And Einstein said a lot of important things, and one of them was, not everything that counts can be counted, and not everything that can be counted counts. Always keep that in mind. Insurance is the most complex area in financial services. That's thanks to Mr. Einstein. So how was Solvency II developed? Come on. Yes. Yes. Okay. Let's look at some of the deficiencies of Solvency I. Obviously, ladies and gentlemen, if you talk about Solvency II, there must have been the Solvency I. Now, what are some of the deficiencies of Solvency I? Too much focus on insurance. And we learned that when we had our first financial crisis of this century, which was a capital market crisis. You may remember the year 2000, the dot-com bubble. What did the insurers discover at that time? They discovered that they had invested in equity and the markets were going down by 70%. And they lost. They lost their capital. And this is not a problem. And the Solvency I is not a problem because Solvency I does not look at market risk. So the insurers were sailing in the fog, virtually bankrupt. And then the supervisors started to realize, careful, there are other risks than just insurance risk. There is market risk, there is credit risk, there is operational risk, and that was not present under Solvency I. The capital buffer, which was referred to as the solvency margin, was obtained by a formula. I will not tell you the formula. It is so complex that it is best to immediately forget about that formula. But that was the problem of Solvency I, not sufficiently risk-based, complex, and how was regulation and supervision old style under Solvency I? Come on, clicker. Regulation, supervision, old style. The capital buffer that insurance undertakings had was determined based on information from the past. Now, what is insurance all about? It's about the future, so it can't be right. The relationship between risk and capital, should not be, yes, thank you very much. So the relationship between risk and capital should not be too close because this might mean that too much capital might be needed. So basically, insurers were operating with too much or with too little capital. Better not have actuaries involved in the Solvency I, because this could be dangerous. No need to consider other risks than insurance risks. Group supervision, a luxury. That's the old style. Well, what is the new style? What will you get now? You will get paradise. You will get a capital buffer that is commensurate with the risks of the insurance undertaking. In a forward-looking approach, you have capital requirements determined on the basis of the risks to which the insurance undertaking is exposed. Technical provisions are calculated on a market-consistent basis. Actuaries will be sitting on both sides of the table. All risks are taken into account. Total balance sheet approach. Group supervision has equal value as solo supervision, and transparency is a key element of the risk-based approach. And this is the birth of Solvency II. It all started out at the end of the last century Slow start, because not considered the first priority. Conceived in 2004, framework for consultation. Healthy pregnancy between 2004 and 2007, delivered in 2009, but as most deliveries, not without complications. Affected by a postnatal depression, the financial crisis. Severely ill, intensive care, injection of an extra dose of vitamins, alive and kicking since the 1st of January 2016. And if you are calculating with me, the 1st January 2016 means that next year we will celebrate 10 years of Solvency II. And now we have the Solvency II review, so it's back in the maternity to get some further vitamins. Let's now look at the main characteristics of Solvency II. The general objectives are, of course, the protection of policyholders. This remains the most important objective of insurance regulation. It's about the policyholders. They have been made a promise, and the promise must be kept. Also financial stability, we talked about that in the panel before my presentation. Financial stability is very important, and insurance should be a source of stability and not a risk of stability. Specific objectives, also the panel discussed this briefly, is to deepen the internal market. Now that is something for you is new. This internal market. Basically in Europe, we work together. We work cross-border. You will have a European passport. You can travel around Europe as insurers. Freedom of service, freedom of establishment. Freedom is always difficult to make sure that everything works. These are specific objectives of the European Union, and then also the further competition. And that is very important. It's also important in the insurance industry that we have innovation. It's one of the biggest problems we have today in the world, but particularly in Europe, is that we do not enough innovate in the insurance industry. People want to sell products so that they can make money as quickly as possible, not thinking about the real risks that should be insured in our society of today. The principles of Solvency II, it's a principle-based regulation, and it's an advice I will give you. And I give you that as a former regulator. You have in front of you a man who spent all his life regulating. Just imagine. I got up in the morning and I said, what am I going to regulate? And I did so every day of my life. One good message to you. Do not over-regulate. Not everything needs to be regulated. Apply the KISS principle. Is that nice? The KISS principle. Keep it simple. Very good message, easy to remember. So we have a principle-based regulation which is then implemented by a delegated act. These are expressions, technical terms that you will have to learn. You know, delegated regulation, implementing regulation. It's a little bit complex, but that's the way it is. And then the guidelines from EIOPA. Good idea, maybe after this conference, Google EIOPA. What's EIOPA? It's based in Frankfurt. It's a European Supervisory Authority. You want to know what happens in insurance? Read the website of EIOPA. Just Google, once in the morning, quick look. This is my agenda. This is where the travel is going. And then the substantive approach is, of course, that very importantly, ladies and gentlemen, and that was the good news that I could bring when I was talking about Solvency II, when we were developing it. And I was talking to the insurance industry, I said, I'll bring you good news. Under Solvency II, you are in charge, not the supervisor. Under Solvency I, it's the supervisor who is in charge. And it's the supervisor that's going to tell you how do you run your business. Under Solvency II, You run your business. And you must, of course, be able to tell your supervisor that you earn that confidence, that trust from the supervisor. Also, very importantly, under Solvency II, you will have to consider that in Moldova also is proportionality. It's obvious that what applies to Allianz should not apply to a small insurer, or should apply in a different way. Don't send 20 inspectors to a small MTPL insurance company to check, That is not an appropriate way of doing things. Complex issue proportionality. I will not expand too much on that. And then very importantly is this idea of a three-pillar approach. I will show you that, well, maybe I show you now. This is what I call the house of Solvency II. If you know this, you know everything about Solvency II. It has three pillars, like in the banking sector. The quantitative side is pillar one. You prepare your solvency balance sheet on a market-consistent basis. You subtract your liabilities from your assets, and you have your capital. And your capital is referred to as own funds. And you must make sure that you have enough solvency capital. Now, how do you know you have enough solvency capital? We have that organized. This is what we call the solvency capital requirement. And the solvency capital requirement is calculated on the basis of a formula. The formula, when you see it as non-experts, you say, my God. But you show that to your actuary, and the actuary says, I love it. It's a beautiful formula. But you may say, I am so smart as an insurance company, I can prepare my own formula. You can do so, but the supervisor will have to approve that. That's pillar one. Very simple. And then, as you can see, we have pillar two. That's in the middle. And pillar two is about risk management, is about governance. Experience has learned that when an insurance company goes bust, is most often not because it didn't have enough capital, but because it was not well managed. And therefore, governance is a key element of Solvency II. It is one of the pillars of the house. Also, the supervisory review process. New in the Solvency II is the dialogue. A dialogue between the supervisor and the insurance undertaking. Insurers will have to say, my supervisor is my friend. I'm going to talk to my supervisor. Tell him or her my problems. And we try to solve them together. That's the vision, that's the philosophy. That's pillar two. And pillar three is transparency. You will have to disclose to the market who you are. Financial solvency and financial condition report. Interesting. Google that. All European insurance companies have to prepare a solvency and financial condition report. So that is something where the insurers go out in public disclosure to the market, explain themselves what they are doing, how they're organized, how is the solvency determined. And then, of course, reporting to the supervisor, supervisory reporting. And that, those of you from the insurance industry in this room, they will hate that, because that's a lot of bureaucracy. You have to do, your IT system will have to be changed, adapted, but the supervisor will help you by providing templates which you can use, using all the digital techniques that we have today, and maybe someday some artificially intelligent thing will do all the calculations for us so that we don't have to do that. That's the three pillars. And you know what is remarkable about these pillars? They are of the same size. What does it mean? They're equally important. And they interlink the doors between the pillars, so you can walk from one door to the other. And of course, the house which was built in Brussels must have a roof. If you don't have a roof on a house in Brussels, where it rains all the time, you get a swimming pool. So we have a roof. And what is the roof? Group supervision. And group supervision, you will also have that in Moldova when you have operators coming from different countries. You have to apply group supervision. And group supervision is the most difficult area of supervision because, ladies and gentlemen, when I talk about Solvency II and the regulation, it's in the first place about people. And we have a group, automatically, when it's cross-border, unless it is Romania, of course, then you talk the same language. But if it's not Romania, it's a different language. Different language, different culture, different mentality. You see it happening. Huh? So that is difficult to organize. So if you know this slide, the House of Solvency II, you have learned a lot. You can already go to the exam on Solvency II. And the next slides, I will go quickly over them. You can read them afterwards at your ease. The Pillar 1. We also talk about the confidence level. How likely is it that an insurer that will hold the capital, which is the solvency capital requirement, that it can still become insolvent? How likely is that? Well, we use here a formula, 99.5% value at risk. We look at a 1-year time horizon. Under Solvency II, it is still possible for an insurer to become insolvent. If this were not the case, ladies and gentlemen, I would not be standing here. Because nobody in the world wants to give a 100% assurance. That is not possible. It's not of this world, because if I were to do that, my premium would be so high that nobody would buy insurance. As simple as that. So the Pillar 2, the SCR, yes, that's the solvency capital requirement, is prospective. We look ahead, we look towards the future. Then the solvency ratio, that is something that you will have to learn to work with. It's like you meet somebody on the street and say, what's your name? And you give the name. Under Solvency II, you meet somebody in the street, say, what's your solvency ratio? And you tell, how is your solvency position comparing your solvency capital requirement with the own funds that you have. And some insurers are very proud about their SCR, and they say, my SCR, solvency capital requirement, is not 100%. It's 200%. It's 300%. So we want to show how strong we are, how we are capable to operate in this world. Then the standard formula, I already mentioned that. The internal model, if you are smart, you can outsmart the regulator, you use an internal model. Investments, that is very important. Here again, this is good news. Under Solvency I, you can only invest in those assets and only for so much percentage as is indicated by regulation. So the supervisor will tell you where you can invest. How boring. You know, it was like a telephone book. And it was controlled whether everybody was investing as it was required. Under Solvency II, you are free. Freedom of investment. The only thing you have to do, you must act like a prudent person. Now, what is a prudent person? By the way, it used to be called the prudent man principle, but we can't do that anymore in Europe. We are neutral. Huh? So it's a prudent person principle. What is the prudent person principle? You will find that in Solvency II. It's beautifully described. And it is so beautifully described that you could even apply it in your private investments. Be prudent. Do never invest in something that you don't understand. It's logical. That's a prudent person principle. So investments, fantastic. You can do as you wish, always in the interest of the policyholders. Because your investments must be such that when there is a need to have the cash to pay, you are capable of doing so. Pillar 2, you remember that the pillar in the middle, it's about governance, the qualitative requirements. 4 key governance functions and the own risk and solvency assessment. Why do we have 4 key governance functions? Well, these are the governance requirements set up by the board, and these are the functions. Why only 4? We could have said 5, could have said 10. You know, we have the governance functions, risk management, chief risk officer, internal control or compliance, internal audit, and actuarial. These are the 4 key governance functions that must be present in any and every insurance company. You can combine some of these functions under certain considerations because they are independent control functions. And that's why we only have 4. We believe that all the companies need to have these. But of course you need a CEO. You need a chief financial officer. Yes, of course. But from a prudential point of view, these independent control functions are necessary. And here again, based on the experience with Solvency II, a message to you. Do not over-regulate. Because this is an area, Pillar 2, where the member states love to regulate. All our member states love to regulate. And the area that they love the most is the Pillar 2. This, oh, what is this person? You know, this risk manager. What can I assign all things to this person, you know? Don't do it. It does not make sense. Principle-based. KISS principle. But the governance functions must be there, and there are independent control functions. And that is very important to make the system work. Risk management. I can talk a long time about risk management. Insurers are professional managers of risk. And ladies and gentlemen, one mistake that is often made is that people say their risk is too complicated. Let's just forget about that risk. Now, one thing is certain. A risk does not go away by not talking about it. The risk will remain. And we have developed this tool, ORSA. This has been one of the most interesting features of Solvency II. And of course, the Vice Governor is here, so I will give him credit. We learned it from the bankers. The bankers applied the same system. And what's the logic? The logic is that we want to prevent that insurers are gaming the system, that they are creating artificial capital, that they are not living up to the principle that solvency means that you are linking risk and capital. And that's why we ask insurers once a year to look at their own risk position, to look where am I exposed, and the capital that I hold in conformity with the legal requirements, is that capital enough? Do I not have risks that are not reflected in this capital buffer? And if so, what will I do about it? And it is at times of the ORSA that you will think about issues such as cyber risk, climate change risk, all these things that we don't like, but these are risks. How are we going to deal with that? Are we going to hold more capital in order to protect us against cyber risk? I would say No, you do that differently. You make sure that your IT system is efficient and well organized. It's not that capital will resolve all your problems. That's the ORSA. Internal control compliance, this is something that I must admit, when you're going to join the European Union and you have to implement the acquis communautaire, there will be a lot of regulation. It's a fact. And in a financial institution, you must make sure that you stick to the rules of the game. Compliance is very important. In practice, all insurance companies will have to get themselves organized that they respect all the rules that have been assigned. And that's one other reason why I'm telling you, if it is not necessary, if EU regulation does not require you to do it, think not once, not twice, not 3 times, but 100 times, always keeping in mind the KISS principle. Keep it simple. Internal audit, I don't need to tell you how important internal audit is. It's the guys that will come in and check whether everything runs as it should be. If it isn't, they will advise management to change. And if management doesn't change, the hammer on the management. It goes directly to the board, and the board will make sure that the management lives up to what was agreed in the company. Actuarial function. A key function in the Solvency II. I have the pleasure of teaching students to become actuary. But ladies and gentlemen, do you know the difference between an actuary and God? God knows he is not an actuary. So you see, these people are special. You will need them. And you will need to also educate them in a way that they can communicate the complexity of the calculations into understandable terminology. And those of you present here who sit on a board of a company will know the worst thing that can happen to the board is that an expert from the company is going to make a presentation. 50 pages. After 2 minutes, half the board is asleep. No, you tell the expert, 1 page, what are the key messages? That's what we teach, that's what I teach my students, to communicate these difficult things in an easy, understandable manner. Supervisory review process. This is also very important because it's not only about regulation, it's also about supervision. And you need to have a solvency capital requirement, and it may be that your capital goes down, down, down. When it goes below the minimum capital, then the supervisor will come and tell you, finita, it's finished. I will take away your license if you're not careful here. And in between the level of the SCR and the MCR, we apply what we call the supervisory ladder of intervention. And the more you get close to the MCR, the more the supervisor is going to be interventionist. So when you breach the SCR, the supervisor will call you in for a cup of coffee. And during the cup of coffee, you'll talk. What can we do about it? And that's fine. And you go home and you do what you promised. If the capital goes down further to the MCR, then of course supervisory action will be taken. Pillar 3, I already mentioned, public disclosure, the solvency and financial condition report, very important. You see also here national GAAP or IAS, IFRS. It's something that particularly for applicant member states, I always say that Don't make your life too difficult. And, imposing international accounting standards, IFRS 17, on insurance companies that sell MTPL, don't do it. Please don't do it. They don't deserve that. They're not going to learn anything from IFRS 17. You can apply the national GAAP. You can apply the Insurance Accounts Directive beautifully. It gives you options. Doesn't get it all these esoteric calculations that are only really beneficial for listed companies, not for small operators on the market. But still, you have some member states that, you know them. It's always the same. They don't listen. Supervisory reporting, that is a very important issue. I have already mentioned that. Public disclosure. This is what you find in the solvency and the financial condition report. I said, Google this, Google this. Just check. It's very interesting reading, Tells you a lot about what insurers are doing. Supervisory reporting, let's pass that. Group supervision. I mentioned group supervision as one of the most complex areas of supervision, because what you need to do in a group, you have to appoint a group supervisor. And the group supervisor calls together in a college of supervisors all the supervisors of the subsidiaries of the group. And they have to discuss then the group issues. It may well be that the parent of the group is situated outside the EU, or that you as an insurer have a subsidiary outside the EU. That is, of course, for the future. Other characteristics of Solvency II is that when people refer to Solvency II and the Solvency II directive, the Solvency II directive comprises all the insurance directives that were adopted in the past. They were recast into one single document, with some exceptions. For instance, motor insurance is not in the Solvency II directive. The IDD, Insurance Distribution Directive, is also a separate directive. The accounting requirements is a separate directive, but all the rest you can find in the Solvency II directive. Experience with Solvency II? Unbelievable. Unbelievable. This huge change in regulation, the biggest since the 70s, went smoothly in the middle of the financial crisis. And I'm very proud to say, ladies and gentlemen, that if we hadn't started preparing for Solvency II in the financial crisis, many insurance companies in Europe would no longer exist. And the insurance industry knows that. And that's why when you talk to people in Germany, France, Italy, Spain about Solvency II, in general, insurers will say it's a good system. Nobody will say it's a perfect system, but it was never intended to be perfect. But it is a good system. It has delivered its value to the market. And that is important. It's important that you know that when you have this foundation, you can build on an insurance market, which goes beyond MTPL to other areas, other risks. It offers the potential for growth in your market. And in a country like Moldova, the growth possibilities are huge in insurance. And Solvency II will help you there. So the impact was rather positive, I would say, and virtually all insurers have an SCR ratio, you now know what that is, which is well above the 100%, and 2024 for the EEA, the European Economic Area, that's the EU plus 3 member states, Iceland, Norway, and Liechtenstein, 244%. Austria, 298, the highest solvency ratio. And Latvia, the lowest, 151%. So that shows the system works, and the system is prudent. So the fact that there is so much solvency capital means that the industry is well capitalized. Why was it so positive? Also, a message that I want to leave with you. Solvency II was not developed top-down, but bottom-up. We did this exercise together. We talked about it every day. We consulted all the stakeholders. We were transparent about at every single step. So people, you know, they were drinking risk management every day. And that has helped the industry. And that is the reason why Solvency II introduction was positive. Also, we had transitional measures. And you will also need transitional measures. You can't go from Solvency I to Solvency II just like that overnight. You'll need some transition. And you need to think about how can we best do that? What's our timing? You know, have a roadmap in which you design your steps so that everybody knows where they are in the process. This is, I have added this slide to show you where insurers in Europe invest in. What's the investment mix? This will look very differently in Moldova. It can't be the same because you have different investment situations. So that is, but you see, very remarkable that equity investment is only 3%. It's very little. The reason is very simple, because we don't know what the markets are going to do. If Trump, if his dog dies, the markets go down, you know. So we have to be very careful as an insurer when we invest in equity. And that is sometimes a problem. It's also something you need to think about. You see heavy investment in government and corporate bonds, which is logical from the perspective of matching assets and liabilities. We've just finished in the EU the Solvency II 2020 review. Solvency II was meant as a system that should be updated regularly. And the first real update occurred under the 2020 review. I'll spare you the details. For your country, most of these things are still too sophisticated. I would spend too much time on that. Eventually, of course, you will have to implement it. Also, there's some changes in proportionality, sustainability, a big issue, sustainability. But if you follow a little bit the developments in the EU, you see that you know, these requirements on sustainability are looked at more critically today than last year. So some of these things will, of course, be also relevant to you. Role of insurance supervision, a different approach. I already mentioned to you this dialogue. At the Solvency I, the supervisor was running your company. Now you run your company yourself, but you need to talk to the supervisor. We call it the dialogue. And a dialogue is not a combination of two monologues. And it is based on trust and based on shared information. And that's why your supervisors will also have to adapt themselves. That was true in all member states. They had to look for new people sometimes, people that were higher educated, to have this complex system work. The advantage is, and I can tell you, that with Solvency II, students at the university are more excited about insurance because this is new. This is the future. This is about risk management techniques, about discovering of new things, and that attracts the students. In the past, to attract a student to do insurance was impossible. And most people in this room that work in insurance will agree with me that they ended up in insurance by accident. I haven't met a person who said, Carl, when I was born, I wanted to become an insurer. I never met a person. Maybe you do, but it is mostly not the case. So a different approach, also in supervision, in the way you talk to your clients, the supervised entities. And that is the principles of modern supervision. Risk-based, proportionate, forward-looking. You try to prevent the problems from happening. Proactive, challenging. The CEO comes to you and says, everything is fine. We are doing great. We have a growth in premiums. It's fantastic. What does the supervisor say? Are you sure? Why are you saying that? Have you looked at this and that? Challenging. Skeptical. Well, you can tell me all kinds of stories. I want to see the facts. And engaged. You want, in a dialogue, you want to have an outcome that is conclusive so that people go home happily. I went to see my supervisor. I passed the test. I'm happy. Let's have a drink and enjoy life. Some lessons from Solvency II. Well, the theory is not always applied in practice as it was intended. And supervisory authorities, it also takes time. Sometimes they have these old Solvency I habits. And it's difficult to make them change their mind. That's something, always keep that in mind. It's not because you change regulation that you change the mindset. That takes time. Human beings need time to change, to adapt to a new situation. Yes, EIOPA. I need to mention that. I have already mentioned EIOPA. The important role that EIOPA is playing in this exercise. That's where the supervisors of all the member states sit together regularly to discuss insurance and insurance regulation supervision. They guide the path of Solvency II. To conclude, Moldova and Solvency II. Why are you concerned? Well, you heard it from the panel. You must implement Solvency II. It takes time, it is difficult, but it gives you as a country opportunities. Because once you are on Solvency II, once you are on a risk-based solvency regime, you will belong to those countries in the world where the vice governor said in Tirana, you can go there, sit at the table. We are part of the club. And that's great, because you earn the respect of your colleagues. And that is always important in this world. The key messages: we live in a risky world. It should be a fertile ground for the growth of the insurance industry, as individuals and businesses are unable to carry the increasing risks. Example, natural catastrophes, pensions, health. Without adopting a risk-based solvency regime, the insurance industry cannot fulfill its socio-economic role of being the manager of those risks. Good governance and risk management are the foundation of a risk-based solvency regime. Introducing a risk-based solvency regime should follow the Chinese proverb. And I can see you, Moldova, with all these things you have to do. You see this mountain in front of you, step by step. Don't get too excited about it, step by step. Transitional measures will be necessary, and remember, Rome was not built in a day. Here it comes. Where do you find the truth? Nothing but the truth. Is it readable? Yes. Is it a must? Yes. Here it is. Solvency II is good for you. I can't go back. So I hope that I've been able to explain you what Solvency II is all about. You see, there's nothing dangerous about it. You just go for it. And I wish you well and good luck. Thank you very much.